Hello, beautiful people. Welcome back to Roseline Across Borders. I'm Roseline, and today we are diving into the world of investing, specifically tailored for absolute beginners. So don't worry if you haven't invested before, you're just starting out. 2025, you are like, okay, this is my year of financial independence, financial freedom. Yeah, one of the ways to hit is also investing, right? So if you've been hesitant about starting your investment journey, this video is your wake-up call. Yeah. So congratulations for seeing this early in the year. Why investing and what is the importance of actually starting early? A friend of mine once shared his regret about not investing earlier, especially during his fully funded studies when he had extra funds. He missed out on the magic of compounding. Don't be like my friend. Let's understand why starting now is crucial. So, I'll try and explain compounding effect. When you hear compound interest and the like, what is the effect of compound interest? Compounding is the process where your investment earns returns, and then those returns earn returns, creating a snowball effect over time. For example, maybe you invest 100 for Nigeria, just use any currency. If it is 10,000 naira or even 100 naira, let's say you invest, let's just use, okay, let us use dollar then. If you invest $100 at a 10% annual return, by the end of year one, you will have $110, right? You know, let's say from January now, you invest $100. By December annual, that's 1 year, at a 10% annual return, you will have 110, which is 10% on that 100 plus the 100 will now make 110, right? So in year two, since you are not taking it out, in year two, the 110 will earn 10%, right? And then that will total 121, because 110 10% of 110 will be 11 naira. 11 naira or $11 plus $110, that would be $121, right? If you invest it in year three again, that 10% of 121 is what? 12.1, right? Right? Yeah. So when you add 12.1 with 121, it will make $133.10. Did you see the effect of compounding? So that is the effect of compounding. Over the years, it will go on and on and on like that. You now see the reason why my friend was actually regretting that he didn't start early. So as you can see, your earnings grow each year, not just from your initial investment, but also from the accumulated returns. This exponential growth is the power of compounding, and you have to know it. You have to experience it, and you have to start. That is the power of starting early as well. So we just also a background, there's difference between savings and investing. Savings are essential for short-term goals and emergencies, but investing is key to building wealth over time. While saving offers security, investment provide growth potentially, especially when you start early and let compounding work in your favor. So saving is different. It is for short-term. If you have a short-term goal, I want to do this, then you save towards it. And for emergency, you save towards them. But when you want to build wealth, then it is crucial for you to invest. For the best your money in your bank account can do for you is, say, 1%. You know how much as a bank giving on your money, you are saving. If they give you, they will still remove out of it for, if it's not SMS, it is for this one. If it's not that one, it's for that. But for investing, your money keeps on growing. So to build wealth, you actually need to consider investing. And yes, this is your wake-up call here. So what you might be asking me that, okay, what investment platform can I get started with now that you have come? So for my viewers from Nigeria, people that are still in Nigeria, you can start. There is Piggyvest. I've used Piggyvest for a long time now. I'll put the link in the description for you. I've been using it for over five years, even more than that. It's a platform that allows you to save and at the same time also invest in. There is fractional real estate on it, meaning you can own a portion of a property and earn return over time. There's bonds. There are a lot of shares you can buy on it as well. It works very well. Another app I will recommend, I'll also leave the link in the description, is Bamboo. Bamboo provides access to stocks and ETFs. I will still explain a bit of those below. And it allows you to invest in both local and international markets with ease. And for my viewers in UK, in Europe, one app that I will recommend you have and start using is Trading 212. I've been using it for the past years. It's user-friendly. It offers a wide range of stocks and ETF to choose from, especially in EU and also UK. You will have a lot of them. And then another one is Referral. This one, since I got here, I've been using Revolut for sending money but recently they've been adding a lot of features that is just breathtaking. I just realized that they also have stocks and also crypto. I knew about those ones and even a lot of ways. There's a video I will dedicate only for Revolut where I will show you what you can do on it. You can keep money and you won't even know that there are pots that you can put money into. It's very beautiful. So the link will also be in the description. Please make sure you get it and then download or and start using and investing in it. So let's quickly delve into understanding stocks and ETF. So there's a difference between stocks and ETF, and the difference is that when you buy a stock, you are purchasing a share of a single company. So this can be riskier because your investment depends on that company's performance. You understand? Yeah. So but for ETF, exchange traded funds, an ETF is like a basket of various securities of such as stocks, bonds, or commodities, and you can buy into them. So this diversification generally makes ETF less risky compared to individual stocks. So stock can be like, Tesla as a company, Apple, Microsoft, Amazon, all these Samsung, anything, Domino's Pizza, anything, a public company, you can buy their shares as an individual. So that will be called stocks. But for ETFs, you can have, top 500 company in the US, they are coming together. That basket of all of them is one ETF. It can be VOO and the likes of them like that. So for some popular stocks are like Tesla, Amazon, Microsoft, Apple, like I've said, and however the prices can be high, so you can consider dollar cost averaging, investing a fixed amount regularly to mitigate market volatility. What that means is that if you have settled it in your mind that I'm starting investing, you can now say, every month, maybe after my salary or after my stipend, I will, maybe it is 10 euros, it is 20 pounds every month. So every month you have your preference already, and then you are sharing it amidst them. This month I put 10 on this, I put 10 next month, upper month. So every time like that. So you don't mind wherever that the price is, you understand? Because at the end of the day, if you bought below, you bought high, you bought below again. When you put everything together and you have it, you will see that okay, at the end of the day you have a good price to buy, and then as it is growing, it is all growing together. You understand? Because you are looking at long term, right? So that is that, and that you can now see which one is risky. So for stocks, it is riskier because if that company, maybe there's a news, they are going lawsuit or bankruptcy and everything, you can lose your money. You understand? But for ETFs, even if one company is going bankrupt, it's still not significantly affecting the performance. You understand? So that's why ETF stocks is high risk and also high reward. You know, anything that is high risk, then it is high reward. Then ETF is low risk and then lower risk rather, and then the return can also be lower, right? So that is how it is. For people that invested in Nvidia is an IT company. When it's skyrocketed, everything skyrocketed, you know. But for ETF of IT, although Nvidia skyrocket, but it didn't get that growth immediately as it was for Nvidia. I hope you get the two now. So that's the difference between stocks and then ETF. But what are some of the important considerations you have to do? Number one, before you start investing, do your research. Understand the asset you are investing in. Also diversify. Don't put your egg in one basket, right? So diversify your investment. Be consistent. Regular investment can harness the power of compounding. You know, that's what I explained before. If it is per month, always be consistent. You know, that's when you will see the growth and then the compounding effect as well. Also, know your risk tolerance. Assess how much risk you are comfortable with. If you are not high risk, you might just want to stay with ETFs and not go with stocks. You understand? So know your risk appetite. You know, are you risk averse or you are risk lover? You understand? So know it, and then with your proper research, you are able to channel your risk appetite very well. So remember, this is not a financial advice. Always consult with a financial advisor and conduct your own research before making investment decisions. Always do that, please. And if you find this video helpful, please give it a thumbs up and share it with others who might benefit, students alike and your friends. Don't forget to subscribe and hit the notification bell so you never miss out on any content. 2025 is a year, yes. So also join our Telegram community. Link will be in the description as well. We discuss personal finance, we share opportunities and grow together. Thank you for joining me today. Remember, the best time to start investing was yesterday. The next best time is now. So let's take these steps together towards financial independence. Until next time, keep thriving. Ciao.